The stability of money is an illusion built entirely on trust, not intrinsic value. Across history, societies have discovered that when faith in a currency falters, people abandon it for assets that hold tangible worth. In 1923, Weimar Germany experienced one of the most extreme cases of this phenomenon, where hyperinflation rendered the mark virtually worthless. Families carried wheelbarrows of banknotes just to buy bread, and gold and foreign currency became lifelines. Trust in currency collapses faster than economies themselves, creating a paradox. Paper promises fail, even when the underlying economy might still produce goods and services. This fragility reveals that money is ultimately a social contract, not a commodity with guaranteed stability. During Zimbabwe's hyperinflation crisis of 2008, monthly inflation rates soared past 79 billion%, turning local notes into near jokes. Citizens turned to US dollars, South African rand, and physical goods like cattle and fuel to preserve value. Even in more developed economies, cracks appear when confidence erodes. The 2008 global financial crisis showed that even the strongest banking systems are vulnerable when trust disappears overnight and liquidity becomes paramount. People instinctively shift from abstract claims of value to hard assets, demonstrating a timeless human response. Gold, silver, and other tangible commodities have repeatedly emerged as refuges when systems fail. This behavioral pattern repeats across continents and centuries, from the collapse of the Roman denarius to modern currency crises. Each instance underscores a universal truth. Trust, not the nominal currency, sustains economic activity. The paradox intensifies during periods of rapid credit expansion and monetary stimulus. While central banks promise stability, the erosion of faith occurs quietly until it reaches a tipping point, prompting sudden asset reallocation. Even subtle signals can trigger mass migration toward hard assets. Historical evidence shows that once confidence wanes, digital or paper holdings become liabilities, while gold, land, and other real assets become perceived sanctuaries. Ultimately, understanding this paradox is essential for decoding modern financial instability. By examining patterns of historical collapse, we can anticipate the conditions under which trust in currency breaks down and hard assets reclaim their primacy. Excessive government borrowing creates pressures that central banks often resolve by expanding credit. This process inflates the money supply, eroding purchasing power and signaling the first cracks in public trust. Sovereign debt-to-GDP ratios provide early warnings of financial stress, as governments increasingly rely on borrowing to fund operations. Historical analysis shows that ratios above 90-100% often precede currency devaluation or inflationary spikes. Central banks respond to debt pressures by lowering interest rates and purchasing government bonds, a strategy known as quantitative easing. While intended to stabilize markets, this injects liquidity that can overheat the economy and reduce confidence in fiat money. Monetary inflation reduces the real value of outstanding debt but simultaneously diminishes savings and wages. Citizens perceive these shifts as a loss of wealth, prompting them to convert paper money into tangible assets. The recurring pattern of credit expansion followed by inflation is visible in multiple historical contexts. From the Bank of England's interventions in the 18th century to modern Federal Reserve policies, the mechanisms remain largely unchanged. Reserve currency dominance temporarily shields nations from extreme crises, as global demand for their money sustains value. However, over-reliance on external trust is fragile, and any erosion of credibility can trigger sudden capital flight. Repeated cycles of expansion and contraction create a predictable human response: flight to safety. Gold, silver, real estate, and foreign currencies consistently emerge as refuges when confidence in local systems wanes. Fiscal mismanagement often amplifies these patterns as governments continue spending beyond revenue capacity. The compounding effect of debt accumulation and monetary easing creates systemic vulnerabilities that can persist for decades. Inflation is rarely linear. It accelerates in waves, eroding middle-class purchasing power first. Early adopters of hard assets often protect wealth, while the unprepared bear the brunt of financial instability. Historically, central banks have used emergency measures, such as capital controls and currency redenomination, to restore stability. These interventions often succeed temporarily, but fail to address the underlying erosion of trust that drives asset migration. Debt crises and currency stress are closely intertwined, forming a repeating economic motif. Observing these patterns allows economists to anticipate which systems are likely to experience trust-driven asset shifts. Excessive reliance on short-term financing magnifies systemic fragility. Governments that borrow to pay interest on prior debt often set the stage for inflationary policy interventions that weaken faith in currency. The transition from commodity-backed money to fiat currency has accentuated this pattern. Without intrinsic value backing, public trust becomes the sole determinant of monetary stability. Modern economies amplify these risks through complex financial instruments, derivatives, and off-balance sheet liabilities. These structures obscure the true scale of debt, masking signals that historically warned of impending crises. The pattern of crisis is consistent: debt expansion, monetary stimulus, inflation, erosion of trust, and eventual migration to hard assets. Each cycle teaches the same lesson. Tangible stores of value always outlast the promise of paper or digital currency. Financial systems are dynamic but psychologically predictable. When citizens perceive instability, behavior shifts rapidly, often faster than policymakers can react. Currency devaluation is both a symptom and a trigger of declining trust. Historical case studies consistently show that once devaluation begins, the rush toward hard assets accelerates exponentially. Globalization spreads these patterns beyond national borders, as capital mobility allows rapid reallocation of wealth. Investors and households alike seek to insulate value by diversifying into assets immune to local policy failures. The economic framework reveals a tension between short-term liquidity solutions and long-term stability. Central banks can stabilize temporarily, but they cannot manufacture confidence, which is ultimately the currency's most critical asset. Understanding this recurring framework is essential to interpreting historical and modern crises. It establishes the groundwork for examining specific case studies where these mechanisms manifested in extreme consequences. In 1921, Weimar Germany faced massive reparations, obligations following World War I totaling 132 billion gold marks. The government began borrowing heavily while simultaneously printing currency to meet these payments, setting the stage for hyperinflation. By 1922, prices began to rise uncontrollably, with monthly inflation averaging over 20%. Workers' wages could no longer keep pace, and citizens resorted to bartering and hoarding commodities to survive. The Reichsbank's policy of financing government deficits with new currency intensified the crisis. By November 1923, one US dollar was equivalent to 4.2 trillion marks, rendering the currency practically worthless. Families carried bundles of banknotes for basic groceries, while gold and foreign currency became the only reliable stores of value. Economic desperation led to social unrest, strikes, and growing political extremism. Meanwhile, Argentina in 2001 faced a sovereign debt crisis that mirrored aspects of Germany's experience. The country had accumulated $132 billion in debt, nearly 57% of GDP, while maintaining a rigid currency peg to the US dollar. The peg initially stabilized the economy, but became unsustainable as fiscal deficits and capital flight accelerated. By December 2001, the Argentine peso was devalued, triggering bank freezes and widespread conversion of savings into tangible assets. Citizens rushed to purchase durable goods, real estate, and foreign currency, reflecting a profound loss of trust in domestic money. Inflation spiked over 40% in the following year, demonstrating the immediate consequences of mismanaged debt and currency rigidity. Venezuela presents a modern parallel, where excessive borrowing and over-reliance on oil revenues created systemic vulnerability. By 2013, public debt reached approximately 50% of GDP, but declining oil prices and expansive monetary policy fueled rapid inflation. Between 2014 and 2019, Venezuela's inflation exceeded 1,000% annually, effectively erasing the value of the bolivar. Citizens increasingly relied on US dollars, gold, and even barter transactions, demonstrating the persistence of historical patterns. In all three cases, policy choices amplified financial stress rather than alleviating it. Excessive borrowing, rigid monetary systems, and unrestrained money printing created conditions where trust evaporated faster than currencies could stabilize. Hyperinflation and currency collapse always lead to a flight toward tangible assets. Whether in early 20th century Germany, early 21st century Argentina, or Venezuela today, gold, real estate, and foreign currency consistently serve as lifeboats. Social consequences of these crises were profound, ranging from unemployment to mass migration. Economic instability forced households to adopt survival strategies that prioritized asset preservation over consumption or investment. In Germany, small businesses collapsed as credit became worthless and wages failed to cover basic needs. Similarly, Argentina saw widespread bankruptcies and protests, while Venezuela experienced shortages of food, medicine, and essential services. Each crisis also triggered systemic banking failures. Depositors lost trust in financial institutions, leading to massive withdrawals, bank closures, and government-imposed restrictions on liquidity. Central bank interventions provided temporary relief, but rarely restored confidence fully. Emergency measures, such as currency redenomination or fiscal austerity, often arrived too late to prevent widespread economic damage. Debt-to-GDP ratios rose dramatically before collapse in each scenario, signaling the inherent risk of excessive sovereign borrowing. Public and investor confidence deteriorated as governments failed to demonstrate sustainable fiscal strategies. Policy missteps often amplified the human cost of financial crises. Price controls, capital restrictions, and delayed reforms extended periods of instability, forcing citizens to rely increasingly on hard assets. Global events further exacerbated domestic crises, demonstrating the interconnectedness of modern economies. Germany's post-war reparations, Argentina's exposure to international markets, and Venezuela's oil dependence all illustrate external factors triggering internal collapse. Economic collapse is rarely sudden. It unfolds in predictable stages. Rising debt, inflation, currency stress, loss of trust, and asset migration form a chain reaction that repeats across different countries and eras. Even when governments attempt stabilization, historical data show that the first victims of collapse are always the holders of the local currency. Hard assets, by contrast, maintain intrinsic value, offering protection against systemic failure. The human response to these crises is remarkably consistent. People prioritize tangible, transferable stores of wealth over promises written on paper or digits on a screen, reflecting a timeless lesson in financial survival. The United States now carries a national debt exceeding $33 trillion, roughly 120% of GDP as of 2025. Persistent deficits have forced repeated interventions by the Federal Reserve, including low interest rates and large-scale bond purchases to maintain market stability. Quantitative easing has expanded the money supply dramatically since the 2008 financial crisis. While these measures stabilized markets temporarily, they also increased the risk of long-term inflation and eroded public confidence in fiat currency. In the European Union, debt-to-GDP ratios in countries like Italy and Greece remain above 150%. These figures illustrate ongoing fiscal fragility, even in developed economies, with access to deep financial markets. China faces a different set of challenges, with local government debt exceeding $8 trillion and property sector vulnerabilities threatening systemic risk. Authorities have relied on state-controlled banks and financial stimulus to prevent defaults, mirroring the interventions seen in historical crises. Global reserve currencies such as the US dollar and euro dominate international trade, creating temporary insulation for their issuers. Yet dependence on trust and geopolitical stability leaves these currencies vulnerable to sudden confidence shocks. Investor behavior reflects historical patterns. Gold, silver, and real estate demand has surged in response to perceived risks. Cryptocurrency adoption has also accelerated as individuals seek alternatives to traditional financial systems. Emerging markets are particularly exposed as high external debt and currency volatility compound domestic fiscal pressures. Countries like Turkey, Pakistan, and Argentina continue to experience inflationary spikes when capital flight accelerates. Central banks now face unprecedented coordination challenges, as monetary stimulus in one region can ripple globally. Interest rate adjustments, currency swaps, and fiscal stimulus must balance debt sustainability with inflation control. Debt-to-GDP ratios are increasingly a political as well as economic issue. As governments struggle to maintain social programs while servicing massive liabilities, these pressures often lead to temporary fixes rather than structural reforms, perpetuating systemic vulnerability. Credit expansion remains the primary tool for maintaining liquidity, yet it carries historical risks. Every major modern crisis, from 2008 to emerging market debt crises, demonstrates that rapid credit growth can precede sudden trust erosion. Private investors respond predictably to instability, reallocating capital into tangible stores of value. Gold, ETFs, luxury real estate, and foreign securities have seen record inflows during periods of uncertainty, echoing patterns observed in Weimar Germany and Venezuela. Banking systems have grown more complex, with derivative exposure and off-balance sheet obligations obscuring true leverage. This opacity delays recognition of systemic risk, creating sudden shocks when confidence falters. Global trade imbalances exacerbate these vulnerabilities as countries accumulate debt to finance imports or stabilize currency pegs. Persistent deficits force repeated interventions that temporarily maintain trust but cannot prevent underlying instability. Inflationary signals are emerging across multiple economies, including the US, EU, and emerging markets. Energy prices, supply chain bottlenecks, and fiscal stimulus combine to pressure purchasing power, demonstrating the real-time relevance of historical patterns. Public perception plays a decisive role in financial stability today, as social media amplifies sentiment and accelerates capital reallocation. Loss of trust can spread rapidly, triggering preemptive moves into hard assets long before formal policy failures occur. Debt accumulation is often masked by financial engineering and accounting practices. Complex derivatives, contingent liabilities, and off-balance sheet obligations obscure true fiscal vulnerability, delaying market recognition of risk. Interest rates remain historically low in many developed economies, incentivizing further borrowing. This paradox of cheap credit amid high debt mirrors past pre-collapse conditions in both developed and emerging markets. Currency depreciation pressures are evident in multiple nations, from the Argentine peso to the Turkish lira. These devaluations force citizens and investors to seek refuge in tangible assets, continuing the historical pattern of flight from untrusted money. Central banks have unprecedented tools, but limited efficacy in restoring trust once it erodes. Even with digital currencies and rapid intervention capabilities, confidence remains the ultimate determinant of monetary stability. Understanding these modern parallels underscores the enduring relevance of historical lessons. Rising debt, expansive monetary policy, and asset migration patterns suggest that history is actively repeating itself in today's global economy. If current debt trajectories continue, sovereign defaults or restructuring will become increasingly likely. Countries with high debt-to-GDP ratios and persistent fiscal deficits will face elevated borrowing costs and declining investor confidence. Inflation is expected to rise in economies heavily reliant on monetary stimulus. As central banks print money to manage debt, purchasing power will erode, forcing households and investors toward tangible assets. Currency depreciation will accelerate in emerging markets with weak fiscal frameworks. Citizens will increasingly convert local money into hard assets like gold, silver, or foreign currency to preserve value. Global reserve currencies may face challenges if trust diminishes, potentially reducing their dominance in trade and finance. Such a shift would create volatility in exchange rates, capital flows, and international investment patterns. Interest rate normalization in developed economies could trigger capital outflows from emerging markets. Investors seeking stability and yield may abandon weaker currencies, exacerbating financial stress abroad. Debt sustainability will remain a critical determinant of economic stability. Nations unable to manage liabilities effectively will experience higher inflation, fiscal deficits, and declining trust in domestic currency systems. Flight to hard assets will intensify as monetary and fiscal policies fail to restore confidence. Gold, real estate, and foreign currency will increasingly dominate private wealth preservation strategies, echoing historical crises. Geopolitical events will compound economic vulnerabilities. Trade tensions, energy shocks, and political instability can trigger sudden reallocations of capital, accelerating the erosion of trust in financial systems. Households and investors must adapt by diversifying holdings toward assets less dependent on monetary policy. Historical patterns suggest that tangible stores of value will continue to outperform paper or digital money in periods of systemic instability. Financial markets will face growing volatility as confidence-driven asset shifts increase. Rapid movement from currency to hard assets will strain liquidity, amplify price swings, and stress banking systems. Government intervention may delay crises but cannot prevent trust from eroding completely. Social contracts underpinning monetary systems can fail faster than institutions can react, creating sudden shocks. Global debt accumulation has reached historically unprecedented levels. If policymakers fail to curb excessive borrowing and restore credibility, the next wave of financial stress could exceed prior crises in both speed and scope. Digital currencies, while promising efficiency, do not inherently solve trust issues. If central banks overextend, even digital money may fail to maintain perceived value, driving renewed interest in gold and other tangible assets. Rising public awareness of systemic risk will further accelerate asset migration. Investors and households are likely to preemptively move wealth into hard assets, repeating a pattern that has persisted for centuries. Economic inequality may widen as those with access to tangible stores of value shield wealth from systemic risk. Conversely, populations without financial literacy or access will suffer disproportionately from inflation and currency devaluation. Structural reforms are unlikely to be immediate, as entrenched political and fiscal constraints delay action. This delay prolongs the period during which trust is fragile, and hard assets gain prominence as safe stores of value. The consequences of continued debt accumulation and monetary stimulus are predictable. Historical patterns indicate that reliance on hard assets becomes inevitable when trust in currency erodes. Understanding these implications allows investors, policymakers, and citizens to anticipate potential crises. Preparation through diversification into tangible assets represents both a historical and contemporary response to systemic financial risk. The ultimate insight from history is that trust, not money, is the most valuable economic asset. Currency, bonds, and digital ledgers hold value only as long as people believe in their stability and acceptance. Even the most sophisticated central banks cannot manufacture confidence indefinitely. When public trust erodes, liquidity injections and interest rate adjustments are temporary remedies at best. Historical crises show that societies instinctively revert to tangible stores of value. From Weimar Germany to Venezuela, citizens sought gold, foreign currency, and real estate long before formal stabilization policies were effective. Modern investors replicate these patterns, demonstrating continuity across centuries. Rising allocations to precious metals, real estate, and cryptocurrencies reflect the enduring human drive to protect wealth from systemic uncertainty. Trust is fragile and easily disrupted by debt accumulation, monetary expansion, and fiscal mismanagement. The faster trust deteriorates, the swifter the migration from abstract currency to hard assets becomes, often outpacing policymakers' interventions. Financial literacy and proactive risk management are essential for navigating these recurring cycles. Individuals and institutions that understand historical patterns are better positioned to anticipate systemic stress and preserve wealth effectively. Ultimately, crises are not anomalies but expressions of predictable economic dynamics. Debt, inflation, currency stress, and asset migration repeat in consistent patterns, underscoring the